Hello and welcome. This is Christopher Aaron coming to you from iGold Advisor. It's August 28th, 2015. Today we're looking at the gold market. I have a lot of people who have asked me for my take on the long term and the short term direction for gold, and I want to provide you with my summary here. Here's a 35-year chart looking at gold. I think it's really important when we're talking about this market, or any market for that matter, to first look at the big picture and then come back and see what's happening in the recent action. Now, again, here's a 35-year history for gold. Gold made a high in 1980 at $850 an ounce. It then consolidated for several decades until this breakout, which proved to be a false breakout, a drop back down below that 850 level, and then a real breakout up here in 2009, 2010 into 2011. The high at 1917 per ounce, now the all-time high, set in 2011. We have here, shown in blue, an uptrend line that was in play from 2005. It was broken here. It's no longer valid. The only trend line that remains valid in analyzing the gold market is this original trend line from 2001. If gold were to fall this low, it would fall down to around 900 per ounce right now, which corresponds, interestingly, with the vicinity of this 850 region, and also the 61% Fibonacci retracement of the entire bull market, which comes here right in around 880. So the point is, I don't know that the correction, that the bear market that's been going on since 2011, I don't know that this bear market is over. This may have one more major leg down and some consolidation to go. And my target for that would be somewhere in that 850 to 950 range, matching all three of these trend lines here. Is that going to happen? I don't know. The low may be in from 1,075 from a few weeks ago. We'll have to wait and see. The major point that I want to make about this is to take into mind the overall pattern that has been developing here for the last 3.5 decades. A high, a multi-decade consolidation, a breakout, and then a holding above that breakout level, shown here in yellow, for the last 4 years. Yes, it's been a serious decline. Yes, people have gotten shaken out and lost a lot of money here. But you're still talking about a correction holding since 2010 above this all-time high, and that is significant, and I'm going to show you why. Here's a log scale chart looking at gold. This is gold on a log scale, which compresses the upper levels here of the price action so that we don't overanalyze it in relation to the beginning parts of the bull market. That's what it really helps me to do. And what you can see here is that the trend line on the log scale has been broken. So there is no trend line in play on a log scale. This is not an exponentially moving market. This is still a market that is looking to move on a linear level. And what that means is that we're not in the final blow-off stages of this market yet. We all know that. Now, interestingly, the upper trend line for the log scale is staying in place, which would indicate to me if this does come back here in the next year or two and test 850, you may be looking at the next move higher to hit this upper log trend line. And that'll be higher than the previous all-time high, of course. The other significant thing about this market here is to look at the relative strength trend line. I'm very big on finding relative strength between markets and analyzing those patterns, because I think that can tell you more, especially when you're in a correction, than sometimes just the action of the price itself. So here we see that gold has been far outpacing a basket of commodities as shown by the CRB index since 2006. And you had basically 25 years where those two moved fairly evenly, and then a massive outperformance by gold since 2006, showing us that what's happening in the gold market is something that is unique to the precious metal of gold and does not have so much to do with the commodity function of it. Now, for those of you wondering, I'm not a gold bug. I don't believe in holding all your assets in gold. I don't believe in holding all your assets in gold for the long term. I do trade other markets. I do trade the gold and silver market. I invest in other markets as well. I just happen to believe that what's happening in gold is very interesting right now, and that's why I'm focusing on it, because I believe I see which way this market is developing as far as a long-term pattern goes. So, what happens with these big, massive, multi-decade consolidations? There's only a few examples that I've been able to find. There's an old investing adage that says, the bigger the base, the bigger the move. And what that basically means is after a market is consolidating for a long time, multiple decades, there tends to be a fairly significant move after that breakout holds. Some other examples include oil, copper, Apple Computer, and 3D Systems stock. And I'm not going to go through all these right now, but I'm going to show two examples just to give you an idea of what may be possible with the gold market here over the next, say, 5 to 10 years. I'm not making a short-term prediction right here, right now. Here we look at oil from 1983 to 2004. It's a multi-decade up and down choppy consolidation with a resistance zone up here of 36 to 42 and a support right around $10 a barrel. After this market breaks out in 2004, you have roughly a doubling from the previous all-time highs. You then have a very swift and severe percentage-wise correction, about a 35% correction over the course of about 6 months here in the oil market, back down to around $50 a barrel. Now, the important thing is that this correction takes us back in the vicinity of this upper level of the resistance zone in the low 40s. What happens next? From this low, from the correction back down to the resistance zone, we have nearly a 250% gain from that previous all-time high. So back of the envelope calculation, from these lows here of a decade earlier, that was roughly a 1,500% gain. The point is, look at this resistance zone, look at the multi-decade consolidation when viewed in the perspective of the final move. Another example is 3D Systems stock. From 1992 to 2010, this stock consolidated with these massive swings during the consolidation, yes, but a resistance zone here clearly defined and a support zone here clearly defined. What happened after this stock broke out? It doubled from its previous all-time high. It then had a 50% correction right back to the vicinity of the resistance zone, the previous all-time highs. And from there, that's the same stock a couple years later. Here's that 50% correction right here where my mouse is. I hope you can see that. Here's the final price, an 850% gain from the previous all-time high. Now, yes, both of these markets have subsequently come back down, but that doesn't negate the gains that were made on the way up. And for those who follow technical analysis or other forms of analysis, valuation analysis, they were selling hopefully somewhere here as this market was getting frothy. So there are plenty of gains to be made even from a market that is going to eventually enter a bubble. And that is my point with the gold market, is that it is not yet in a bubble. It did not reach a bubble. It may eventually reach a bubble. It probably will. And there are going to be some very clear fundamental signs for gold when that happens. But I don't believe it's happened yet. Let's look at it one more time. Here's the 30-year basing pattern for gold. This yellow line is the previous all-time high around 850. From 1980, this big curve, this big cup, one attempt, a second attempt to get above this resistance zone. All in all, a 30-year basing consolidation. What happens next? We have roughly a doubling after we break out from the previous all-time high, and we've had roughly a 50% correction from that doubling. It will be slightly more than 50% if it comes back here to this final trend line. My point is that the gold market seems to be analogous to where the oil market was when it corrected back down to $50 a barrel in 2006, and where 3D Systems was when it came back down to that $9 per share level after it broke out. That's where the gold market is now. My expectation would be that this market begins a bottoming period right now. I don't believe this market is going to immediately accelerate back up to 1900 within the next year or 18 months. I think what you're going to see is a bottoming process, whether that final bottom is in now or whether it's not going to be in for the next year remains to be seen. I don't have a crystal ball. I never claim to have the absolute truth. What I like to do is compare relative periods of history and see how certain examples that appear similar to me may play out. Why? Because the markets are the sum of all the human beings that are involved in that market, and human nature doesn't change over time. It's just the markets that human nature plays out in. My predictions, with that said, if you want to put me on the spot, it's that we have the final bottom occurring here between 850 and 1,075 per ounce over the next 6 to 12 months. I then think we'll see that basing consolidation pattern here happen somewhere between that final low and 1350 per ounce, which was one of the swing highs here from 2012, 2013. That will probably base in a back and forth, slightly upward sloping manner for about a year or two. And then I would expect that in 2018 and beyond, you would see a true resumption of this bull market, challenging and eventually exceeding that $1,917 per ounce level. I don't think that'll happen right away. It often takes multiple attempts for markets to exceed a previous all-time high. I expect that would be the case here. So all this is just to say to those of you who are in the gold market, who have been holding through this bear market, or who are not in the bear market, who are not in the gold market at all, but who are considering whether this is the time to enter the market or whether to wait, I would say you're probably entering a bottoming period here, and that this would be a time to begin to accumulate some positions in the gold market. I'm not saying buy all at once. I'm not saying trying to time the absolute bottom. Leave that to the professionals who often fail at it. What I am saying to do is this would be a time over the next 12 months or so to begin to establish some positions. Maybe a dollar cost average sort of approach might be best. And I think it'll be an exciting few years coming ahead for everyone who's involved in this market. I really do. Gold as a historically monetary metal, yet with significant jewelry and industrial demand, will have some very interesting dynamics here in play, as what we can see happening in the last several weeks in the currency markets starts to heat up, maybe with some other countries devaluing their currency, maybe some continuous fluctuations in stock markets and currency markets. It'll be very interesting to see it all play out. Thanks for joining me, guys. Again, this has been Christopher Aaron. You can check out my website at igoldadvisor.com. and I'll be posting some more analysis here in the upcoming days for you. Thank you for joining me.